Multi-decade high mortgage rates have seized up the housing market, but there are some signals coming from the bond market that point to potentially lower rates in the not too distant future. In today's video, we're going to look at the current mortgage rate trends, how recent economic data may affect the Federal Reserve's future monetary policy, and what's going on in the bond market that points to potentially brighter days ahead for real estate. My name is Eric and I am a professional economist in addition to being a licensed real estate agent. Let's get into it. According to the latest data from Freddie Mac, the average 30-year fixed-rate mortgage was 7.44% as of November 16th. This was down slightly from the recent peak of 7.8% 3 weeks earlier. And while this decline is welcome news for buyers, when we zoom out and take a look at where mortgage rates have gone over the last few years, we can see that we need some much bigger reductions than just a few tenths of a percentage point in order to get things going in real estate again. It has been the Federal Reserve's tightening of monetary policy that has led to these multi-decade high mortgage rates. But we could very well see an end to their Fed funds rate increases quite soon. At the end of their most recent meeting on November 1st, the Fed chose to take a pause on another interest rate hike. And while Fed Chair Powell did leave the door open to another rate increase, recent economic data suggests they may not raise rates anymore. Third quarter GDP grew at a 4.9% annualized rate, the strongest growth for the U.S. economy since the fourth quarter of 2021. If the economy continues at such a strong pace, we would most certainly see more rate increases. But the first few data points for the fourth quarter are pointing to an economy slowing down. Non-farm payroll employment grew 150,000 jobs in October, lower than expected and far below the 2023 average of 250,000 jobs per month. And it wasn't just the labor market showing signs of a slowdown in the fourth quarter. Retail sales for October declined by 0.1%, the first month-over-month decline since March of this year. The slowdown in October consumer spending was also seen in credit card data tracked by CNBC and the National Retail Federation. The decline in their data was similar to that of retail sales, dropping by 0.08% month-over-month. While we can't put too much weight on just 1 month's worth of data, the fact that we're seeing a slowdown in economic activity across multiple indicators suggests it's not just a fluke in the data. I'll be doing a deep dive on the most recent economic data in an upcoming video on my other channel, PapayaCast, so make sure you're subscribed over there if you want to see that video when it comes out. I'll leave a link to that channel in the description down below. At this point, you may be asking why an economic slowdown is important when it comes to mortgage rates. An economic slowdown is exactly what the Federal Reserve is trying to achieve with their interest rate increases. They are watching this data closely, and if they feel that they have reached an appropriate level in their Fed funds rate to slow down the economy to bring down inflation, they are less likely to raise rates anymore. Were they to signal that they are done raising rates, this would likely get a significant reaction from the bond market and send Treasury rates lower, which has a much more direct influence on mortgage rates than the Fed. And that brings us to the next big indicator to watch when it comes to an outlook for mortgage rates, the U.S. Treasury yield curve. Here's what the U.S. Treasury yield curve looked like on October 3rd in my last mortgage outlook video. The yield curve is a reflection of the expectations of bond investors for where interest rates are headed. What we want to look for is when the yield curve inverts, which happens when short-term rates are higher than long-term rates. Back on October 3rd, it inverted between the 6 and 12-month Treasury, meaning the bond market anticipated the Fed would reverse course sometime between April and October of 2024. Now let's look at where it is now. Here's the yield curve as of November 16th. You'll notice it now inverts between the 4 and 6 month Treasury, meaning the bond market now expects a Fed pivot between January and March of 2024. A significant shift from where it was a month prior. Also, notice how the further out we get in the yield curve, the bigger the difference is in yield. Back on October 3rd, the 30-year Treasury was at 4.94%, but now it is at 4.65% as of November 16th. This is yet another sign that the bond market expects rates to start heading lower as we move forward. So, what does this all mean for mortgage rates? If the economic data continues to come in soft for November, the Fed is unlikely to raise rates at their next meeting in the middle of December, and that could mean the end to their interest rate hikes. The bond market will certainly take note of this, and the yield on the 10-year Treasury is likely to head lower. Since the Fed's last meeting ended on November 1st, the 10-year yield has been steadily trending lower. In fact, it has been on the downtrend since reaching a peak of about 5% in the middle of October, when markets were starting to expect the Fed to pause on rate hikes. The 30-year mortgage is influenced most by the 10-year Treasury yield, so if we have seen a peak in the 10-year Treasury yield, that probably means we've seen a peak in the 30-year mortgage rate. From there, it can only head lower. The bond market currently expects the Fed to pivot between January and March of next year based on the yield curve inversion, so we could be well on the way to a steady downtrend in mortgage rates starting in the first half of 2024. This will be a big boost for real estate as homes become more affordable to buyers, and sellers will be more willing to list their homes if they know they can get a mortgage rate on their next home that isn't at multi-decade highs. If you like this type of forward-looking real estate analysis, I hope you will consider subscribing to this channel if you haven't already, and hit that notification bell down below so you know right away when my next video comes out. And if you found this video useful or at least mildly entertaining, make sure to hit that like button on the way out to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.